Right, so let's just discuss two more important issues here and then do a TYU1 sort of look at this. Right, so the first one is to do with fair value. Fair value and the associate. So in exactly the same way that the standard really wants us to treat the associates in exactly the sorry the yes the associate that we're dealing with in exactly the same way. We should find its fair value before we start working. You can see that there would be irregularity if we were looking at just the net assets of the associate and looking at the fair value of the subsidiary when we come to consolidate and even include the value, the full value or our share of the associate in our group accounts. So typically, if the fair value of the associates' net assets are materially different from their book value, then these should be adjusted in exactly the same way that we deal with the subsidiary. And then, and generally, because this is a completely different company, we do not sort of remove any intercompany relations, any trade, any sales. We don't do any of that. That's one thing we don't touch. We sort of leave it. So any payables and receivables as a result of this relationship, we leave alone. We leave alone. What we do focus on, of course, is this business of any unrealized profit in the inventory of the associate. Exactly the same way we eliminate any pups. But remember, it's just our share. We don't the inventory belonging to that's not ours that we don't control. We have no business removing because we never included that in ours, right? It's just our own share. That's all. It's exactly the same process. Right. So let's do yes. Let's do the first TYU, which will help us look at these two issues, I believe. At least I know one of them. I'm not sure if it does any fair value, but let's see. Let's look at the situation. So this is TYU1, and I'm going to walk through this. Typically, I will always work through the workings, and then I go back and look at the answers. But the workings are what's critical. The workings are what's important here. So here we are. Statements of financial position of 3 entities as at the 30th of September. Here's the parent, subsidiary, and here is the associate. Suitably named parent, subsidiary, and associate. Right, and here we are. So what we see here is that, let's look at the situation here. 4,500, all good. I think it's important to just pick up on these points. Just see what's happening here. Just be aware. Look at here. We have investments, so we know that this 10,000 is made up of S and A at least. There might be other investments. I don't know. It doesn't really matter. But the key point is we just follow the information. So let's look at the first bit of information. So P acquired 75% of S. So the first thing is always to write. I think it's always a good idea to write your, sort of do your sort of relationship. P acquired S, 75% of S. So we know that you have 75% of the subsidiary. Thank you very much. Paying 5 million in cash, and that's nothing new. Again, you guys know how to deal with this. You can calculate goodwill. It says at that time the balance on S's retained earnings was 3 million. So let me just do that quickly, just because I'm here. So that's the working. So that's my working 2, right? So this is working 1. I'll complete this in a second, but my working 2 doesn't like it when I've started writing. Let me just get rid of that. Just get rid of that so I can create a new page. Okay. Oops, sorry. Oops, sorry. Let me come out here. Let me come down here. Okay. Let me just create another page as well so I can write. Okay, great. So let me go back up. So P has 75% in S, and that's what we first of all have. So that's control. So let's look at working 2 for this. So working 2, of course, net assets at ACCA, net assets at reporting, post-ACCA. post-ac. So what do we have here? So you have, let's look at this subsidiary. I'm just doing the subsidiary just because 1,000 and 5,500. That's what's happening at the year end. 1,005.5. So let me just write that in there. So ordinary share, retained earnings, 1,000 and 5,500. This of course must be 1,000 as well. And it tells me here that this was when you bought this thing, it was 3 million. So that's 3 million, and that's working too, really. Nothing new again, of course, yes. So let's carry on. This is working one over here. Then let's look at what it says next. It says that then P acquires 30%. So they tell us. So that's good. This is kind of them. I'll just change my pen color. I'll draw there. And there we have that. I change that. Acquires 30% of A. So that's just, I'll just do a little, yes, 30% A. So you can please do this in your appendix section. Completely different. I'm just almost saving paper of A. And technically, I mean, you can call it what you like. I'm just going to call it working to B, just because it doesn't matter. You call it what you like, just because I want to see what's happening straight away now. So when I look at this, you don't have to do it this way. I'm just doing it, just one idea. So 500 here, net assets at acquisition, net assets at acquisition, net assets at reporting, 500, 500, and when I look here, I see that, what do I see? Here we have retained earnings at 2,500. So that's at the year end. So 2,500 here. And then I look up here and I see that it says here that the balance on the retained earnings was 1.5 million. So this is 1.5 million. Right, so this is ordinary shares again. And this is retained earnings. So I can see what the post-ac is as well. So you know what it is you're come to take a percentage of to top up or add on to your. And it says that when you acquire these people, you paid, it's very clear, it tells us there that you paid 750,000 in cash. So you paid 750,000 in cash. So whatever the post-ac is, you're going to take that on, create your little working. So I'm just going to even start that here. So your opening balance, 750,000 in cash. And we're just going to put here add on share, which is 30% of post-ac. We'll calculate that in a second, but so at least you know where we're going. You know where we're going. Right. Now, let's look at this carefully. So that's that. So let's look at, and you know what? Why not? Let me just go away. Let me just do the goodwill. Let me do working 3. Let's just do working 3. I'm just going to do working 3. Change my pen color again to black. Working 3. So goodwill, of course, only on the subsidiary. And what do I have here? I have here consideration. Of course, remember, this is only to do with the subsidiary. And the 25% of the non-controlling interest, right? The fair value. So it says here non-controlling interest is valued using the fair value method. Value of the non-controlling interest was 1.6 million at acquisition. So this is 1.6 million. I'll just put the zeros on top. You know that's 0, 0, 0 over here. Consideration is given to us. It tells us that you paid 5 million, if you like, in cash. So we have here 5 million. So we have a total, of course, this is you own 75%. So we have a total of 6,600. So we now have here the net assets at acquisition, which is the subsidiary. The subsidiary here. Let me just check to see if there was any fair value movements. There's nothing. I think they just want to kind of highlight this point here. There's no fair value movement. Typically, you'd look out for that. You look out for any fair value. You look out for any fair value. Is the point. So there's none. So what do we now do? We just literally now, I can now go away and just, if you like, calculate the situation. So I have here 4 grand. So I just take away the 4 grand from here. That's its acquisition, 4 grand. And then of course I have here 2,000. 600. And of course, this is my goodwill. I will find out whether it is impaired very quickly. It doesn't tell me, does it? Associate is impaired. Goodwill is not impaired. So there is no impairment of goodwill. It's the investment that's impaired, so that's different. I'm looking to see if goodwill is impaired. There's no goodwill impairment, so that's brilliant. So that means, and then there's no P sold goods to the associate, so that's to do with the associate. So P's not selling anything to the subsidiary, so there's no drama in this question. So literally, my post-tax is 2,500, and that, if you like, and here we have 6,500, 2,500. So let's now look at the situation of the perp. Let's look at the perp. I'm going to call it working for. Doesn't matter. And it says here that parent sold goods for 1 million at a markup of 25%. So let's get the drawing up. I think it's important to do that. So parent sold goods at a markup of, well, 1 million and a markup of 25%. So therefore, yes, it says 25%. So 1 million is technically the equivalent of 1.25 or 125%. So let me find out what the cost is. So the cost, of course, which is 100%, if this is 125%, we definitely would be, let me find out what that is. That would be, of course, 1 million divided by 5. Oops, 1 million divided by 1.25, which of course tells me that the base cost of this is 0.8 million, which means that the perp, or the profit sitting on this stock, is, if you like, 200,000. So you have a stock that originally cost 800,000 now costing 200,000. Now let's look carefully at what the question is really telling us. So I'm using this example to explain the problem here. So it says here that P sold these goods at the year end. A still has a quarter of these goods. So A still has a quarter, right? So it sold 3/4. I'm going to change my pen color. So it sold 3/4. Sold 3/4. And it still has a quarter of the goods left. And therefore, a quarter of these goods, if I do a quarter here, 1/4 times 200,000 is 50,000. So here we have 50,000 as a perp, right? Still left. And I could also do a quarter here, of course, just because, and have this as 200,000. So I have goods currently sitting in the stock at 250,000. This is in the stock of the associate, the whole associate, right? Now, so there's this perp here, there's this profit. So I'm recognizing, if you like, some profit, of course, that I'm going to recognize profit anyway, by virtue of what I'm, if you like, my ownership in this business. But here's the thing. The stock is 50,000. If I owned the whole business, I would eliminate the stock, right? I would debit my retained earnings, right? And I would credit the inventory. We've done this with the 50,000. But I don't own all this. I only own 30% of this business. So therefore, the only profits that I would have been able to recognize when I now come to get my share of this business, if you like, must be my share, which is 30% of this inventory. I'm basically adding it into my own profits, but it's stock that I cannot recognize because I own, if you like, I own the company. So you can't really sell to yourself. You have to eliminate any profits that you, if you like, are declaring as your own as well. If that makes any sense. So the key point here is that you need to find out what your share is of that perp, which is 15,000 in effect, right? 30% of that, because that inventory technically has just moved from one room into another room because you own it. At least that's the argument, that you still own that inventory. So you need to recognize it at its original value. It hasn't truly left the business, so you cannot recognize that additional profit yet. So this becomes what we recognize. So you can see the first thing I did was to find the actual perp itself and then take my percentage of it. And then, of course, the process really now is to debit retained earnings. Of course, 15,000, of course, in the parent. yes, which would be working 5, and credit the investment, credit my investment with 15,000, because my investment will include a share of this profit of the value of the business, and I need to remove that. And that's how we deal with the perp. That's the process for dealing with this question here, dealing with this thing here. So it says that the P was owed 250,000 at the reporting date. Like I said to you, we don't do anything with any intercompany trade. We don't touch it. That's fine. Leave it. It's external enough. We only have significant influence. It's not enough to exclude or remove. So this is fine. We leave that alone. And it says that the investment was impaired by 35,000. So I need to impair that figure. So coming back here, so I will do my own. I will, like I said here, I will have here. Remember this business here. This includes all that closing inventory, this net asset figure here, because I have here A minus L, right? The stock is in here, so I need to take that out. So what do I have here? I have 1,000, of course, right? That's the post-DAC of that associate. I can only recognize 30% of that. 30% of that is 300. Then, like I said, I need to take off the perp, take up our share of the perp, which is 15. And then I also need to recognize the impairment, which is 35. And that becomes my new share of profit. Yes, my new share of profit. Yeah. And that pretty much is it. Let's go to the answers. So I can sort of show you again, like I say, it's almost easier so that you can work through. The workings are what are critical, so you can now work through putting it together and just kind of concluding it, doing the addition, the adding in. So we calculated the goodwill. Let me just take you there to show you that to you. We did the goodwill. That's 2,600, of course. You can see that there, goodwill. Put that at the top. Just add those two together. Plant and this is the subsidiary. Nothing happened with that. So, of course, the investment we need to take out. Of course, well, when I say we need to take that out, we just want to separate out clearly the investment in S. That needs to go, and of course, that's the investment in A. So take all that out. Keep the other investments on their own. You now have your investments in your associate. Write your 750 here, and then add on things as you go along. Add your current assets together. Then you have your equity and your add all that. Add all your non-current liabilities, current liabilities. Pretty straight. Nothing crazy there. Not much was happening with the subsidiary, to be fair, in this question. We calculated this. Remember your 2,500 from your main subsidiary. Then, of course, we had the goodwill, and the goodwill was your parent, the 5,000 plus the fair value, less the fair value of the net assets acquisition, 4,000. So your total goodwill, of course. Well, sorry, we've done that already. So this is the non-controlling interest of the subsidiary. Just deal with that. That's a fair value and its own share of the profit. We do this already. This is what we're trying to learn. The group retained earnings. So that's the 100% parent. That's 75% of the 2,500 standard working to. That's the associate at 30% of those profits that we did. Right. I'll just take you back there again. Of my own version of working to. That was the 1,000, right? And I took 30% of that, giving me 300, right? So that's the 300 there. That's the 15, the perp that I worked out, and that's the impairment, right? And that's working 5. So that's kind of how we play around with that. Cool, great stuff. Well, I hope that's helped. Again, this is just a breakdown of how we deal with that, but hopefully you can practice that and then get into. I think we were talking about this in class. You want to lay this out. Just write all these headings out and then chuck everything in, leaving these ones blank because you know you're going to be doing the workings, and then you just come in and just fit those answers in. Right? Okay. Awesome. See you in the next video for TYU2.